Welcome and introduction to the topic. Warm greeting. Welcome to this comprehensive guide on understanding and mastering the concept of margin of safety. If you're looking to safeguard your investments and improve your decision-making process, this video is for you. Explain the structure. This guide will take you step by step through one of the most powerful and essential concepts in value investing, the margin of safety. This concept, introduced by Benjamin Graham, has been used by some of the world's most successful investors, including Warren Buffett. Set the scene for the next few hours. Whether you're new to investing or a seasoned professional, the margin of safety can change the way you view risk and reward in your investment journey. Benjamin Graham's legacy. Discuss Benjamin Graham's career and his impact on modern investing. Benjamin Graham, the father of value investing, transformed the landscape of the stock market with his groundbreaking theories and principles. He introduced the concept of intrinsic value, the importance of fundamentals, and most notably, the margin of safety. Mention other key concepts Graham introduced that are intertwined with margin of safety: Mr. Market, intrinsic value, and the importance of a disciplined, rational approach to investing. Briefly explain how his ideas helped shape modern investment philosophies. Understanding the margin of safety. What is the margin of safety? Define the concept. The margin of safety is a buffer or cushion that allows investors to make mistakes without significant loss. It's essentially buying an asset at a price well below its intrinsic value, ensuring that even if your valuation is slightly off, you are protected. Simplify the definition with an analogy. Imagine you're driving a car on a slippery road. The more margin you have between your car and the edge of the road, the less likely you are to fall off. In investing, the lower you buy an asset relative to its intrinsic value, the less likely you are to incur a significant loss if market conditions fluctuate. Why is margin of safety important? Discuss the psychological and emotional aspects of investing. The stock market is filled with emotional swings. Fear, greed, and euphoria often dictate stock prices. Graham emphasized the importance of separating emotions from investing, which is where the margin of safety comes into play. Explain the safety net analogy in more detail. By purchasing securities with a margin of safety, investors are essentially building a protective barrier. No matter how rational the market gets, if you buy a stock at a steep discount, there's a much smaller chance you'll lose money in the long run. Provide historical examples of market crash and how a margin of safety would have protected investors. Intrinsic value and the margin of safety. Explain intrinsic value. Intrinsic value refers to the true, underlying value of an asset, its worth based on fundamentals such as earnings, growth potential, and risk factors. Introduce methods for calculating intrinsic value: discounted cash flow, earnings power value, etc. Discuss how to determine a margin of safety based on intrinsic value. If a stock is trading at $60, but your calculations suggest its intrinsic value is $100, buying at $60 gives you a significant margin for error. Provide detailed examples, walking through calculations and showing practical applications. Let's say we analyze a company and estimate its future cash flows. Building a portfolio with margin of safety. Choosing stocks with a margin of safety. Discuss the process of identifying undervalued stocks. The key is to find companies whose intrinsic value is significantly higher than their current market price. We'll discuss how to analyze stocks using financial statements, historical performance, and future growth potential. Explain the importance of company fundamentals. Look for companies with strong balance sheets, low debt, and consistent earnings. Provide a detailed walkthrough of analyzing a stock, showing key ratios and indicators: P/E ratio, P/B ratio, debt to equity, etc. that help identify value. The role of diversification in margin of safety. Explain how diversification acts as another form of risk management. Diversification helps spread risk across different industries, sectors, or even geographical regions. By holding a variety of assets with their own margins of safety, you can minimize the overall risk of your portfolio. Discuss the idea that diversification does not mean spreading yourself too thin. Focus on high-conviction investments with strong margins of safety. Alternative investments, bonds and real estate. Discuss how bonds can provide a margin of safety by being less volatile than stocks. Bonds provide a fixed return over a set period of time and can act as a counterbalance to more volatile stocks. Explain how real estate investments, particularly those bought below market value or during downturns, can offer a margin of safety. Real estate investors often buy properties at a discount, either by renovating or waiting for the market to improve. The role of patience in applying margin of safety. Discuss how patience is essential. One of the most challenging aspects of value investing is having the patience to wait for the right opportunities. The market can be irrational for long periods, but by buying with a margin of safety, you're allowing yourself the time to wait for your investment to reach its true value. Section 3. Case Studies and Real-Life Examples. Case Study 1. The 2008 financial crisis. Walk through how the financial crisis was a perfect storm of irrational market behavior, and how a margin of safety would have saved investors. Provide specific examples of companies that were undervalued before the crash and subsequently thrived. Case Study 2. Warren Buffett's investment in Coca-Cola. Discuss how Warren Buffett applied the margin of safety in his famous investment in Coca-Cola. Buffett bought Coca-Cola when it was undervalued and generated massive returns over time. Analyze Coca-Cola's fundamentals at the time of Buffett's purchase, showing the margin of safety concept in action. Case Study 3. The dot-com bubble. Explain how investors who ignored Graham's principles during the dot-com bubble suffered massive losses. During the dot-com era, investors bought companies based on hype, not fundamentals. The margin of safety was ignored. Discuss examples of tech companies that inflated in value and then crashed. Case Study 4. Investing in bonds during a recession. Walk through a recession scenario and how bonds purchased with a margin of safety could protect investors from stock market volatility. Overcoming emotional investing. The psychology of investing. Delve into why investors often act emotionally. The stock market can cause panic and excitement, and this leads to poor decision-making. Graham's concept of Mr. Market, who swings from extreme optimism to extreme pessimism, shows how investors can react irrationally. Explain how a margin of safety shields investors from emotional decisions by encouraging rational, long-term thinking. Behavioral biases and the margin of safety. Discuss how biases like confirmation bias, loss aversion, and herding behavior can influence investment decisions. Investors are prone to emotional biases that distort their judgment. The margin of safety helps neutralize these biases. Provide practical advice on overcoming these biases by focusing on intrinsic value and margin of safety. Emotional discipline in value investing. Explain the importance of emotional discipline in value investing. Value investing requires staying calm in the face of market noise and being willing to go against the herd when the margin of safety is present. Provide strategies for staying disciplined, such as sticking to a predetermined investment plan and using stop-loss orders when necessary. Advanced techniques and conclusion. Advanced valuation techniques for margin of safety. Dive deeper into complex valuation methods, such as discounted cash flow DCF, earnings power value EPV, and net working capital method. Show how these methods can help identify opportunities with a substantial margin of safety in different sectors. Real-world application in global markets. Discuss how the margin of safety can be applied to international investments and how economic conditions in other countries may affect your margin of safety. Highlight the importance of factoring in currency risk, geopolitical risk, and local market conditions when applying Graham's principles globally. The timelessness of the margin of safety. Recap the core principles discussed throughout the video. Emphasize how the margin of safety remains one of the most important concepts in investing today, especially in a market that can often be unpredictable. End with encouragement to apply these principles by adopting the margin of safety approach. You're not just investing in stocks, you are building a strategy for long-term financial security. Asterisk. If you're new to the channel, don't forget to subscribe and ring the bell for notifications so you never miss a video. We dive into a lot of value investing principles, stock market insights, and personal finance tips to help you grow your wealth the smart way. Asterisk. Thanks for spending your time with me today. I really appreciate all of you for being part of this community. Keep learning, keep investing wisely, and I'll see you in the next video.